We might have heard this jargon financial statements quite often. What do we exactly mean by that? What are the contents of financial statements? If I say prepare financial statements, what will you do? There are four components of financial statements. One, income statement, also called profit and loss account or profit and loss statement. We have statement of owner's equity, also called statement of retained earnings, balance sheet, cash flow statement, also called statement of cash flows. So these four together we call as financial statements. For the accounting equation example that we saw in the previous module, shall we prepare financial statements? We'll take up one by one. Look at this. This is the income statement of the business of Corner for the month ended November 30. So income statement is always prepared for a period. Please understand this very clearly. Income statement is always prepared for a period. So during the period we had fees 7,500. To repeat, during this period we had fees 7,500. And these were the various expenses, wages, rent, supplies, utilities and miscellaneous we had. So when we remove all these expenses from the fees earned, we have a net income of 3,050. So your income statement for the month ended clearly says you have made a profit of 3,050 rupees. Now, to whom this profit belongs to? Obviously, we know it belongs to the owners. So from here, we will move to the next statement called statement of owner's equity or statement of retained earnings. Again, when we say statement of owner's equity, it is for the month, meaning it is prepared for a period. So we begin with the opening balance as on November 1. You know very well, it is a newly formed business, so there cannot be any opening balance. That is why it is 0. And during the month, that is on the very beginning, Ramcharan invests 25,000 rupees. That is nothing but the capital. So to this we add the net income or the profit for the period 3,050. So together then business owes around 28,050 to owner. But we know that Ramcharan withdrew 2,000 rupees. So obviously the closing balance of capital account is only 26,050. To quickly summarize, initially he gave 25,000, we added profit 3,050, so it came to 28,050, but because he withdrew 2,000, now the business owes only 26,050 to owner. So from here, logically, we will move to the next stage called balance sheet. Look at the title here. Balance sheet is as on November 30. So please understand, your income statement is prepared for a period, whereas balance sheet is prepared as on a given date. That is why income statement gives you profit or loss for the period, whereas your balance sheet talks about the financial position as on given date. So Soft Corner business owns these assets, cash, supplies, land and so on, totaling 26,450. It has only one liability, that is creditors, it to be paid 400 rupees. We saw in the previous statement that business owes 26,050 to Ramcharan. So now if you add these two, you will get 26,450, which is equivalent to assets. So having seen income statement, statement of retained earnings and balance sheet, the last one we have is statement of cash flows, also called cash flow statement, again prepared for the period. So normally what we do is we break the cash flows into operating, investing and financing. And we try to see how the cash came in and how the cash went out during this period. We check up the cash inflows and the cash outflows during the period. Purposefully, I am not getting into the details of this statement now. You can just have a look at it enough. But we have a separate chapter of cash flow statement where we will get into the details. So you can just have a look at this for some time, try to understand. We have seen all this data, but I am not explaining this as of now. Thank you.